Hello, I'm David Frazier, the President and Chief Market Strategist of Frazier and Mayer Research LLC, the providers of Investors Monitor and InvestorsMonitor.com, as well as our individual investor service, Frazier's Strategic Allocator. In this week's video, I'm going to discuss a little bit about the upcoming election and my thoughts on how I'll likely advise you to invest your money in the financial markets depending upon who wins the presidential election. And I'm also going to go over some more information that's provided at our internet website in an effort to help you to avoid the big downturns and to profit from the major upturns in the worldwide financial markets. First, a little bit of housekeeping, however. Even though I'm recording this week's video at around 10:30 in the morning on Sunday, November 6th, which will be posted at our website either later today or on this coming Monday, going forward, that is beginning in the week ahead, I'm going to record these videos on Fridays of every week so that we can post them to our website as well as to our different websites. We post these recordings on our internet website, and we also provide them through Weiss Research. And the reason being is quite simple. I really don't want you to have these videos available only on late Sunday or Mondays of every week. I want to give you more time and the ability to watch and listen to these videos at your own leisure and when you don't have other regular weekday distractions. Let's see. Other than that, yeah, that's it. So first, a little bit about the upcoming election. Well, those of you that tuned into the webinar that I produced with Weiss Research about a week and a half ago, I think you should have a pretty good understanding of my thinking regarding how the markets are going to perform depending on who's elected as the president, as well as whether or not the Republicans are able to maintain or not maintain their control of Congress. And in either environment, whether Hillary Clinton's elected or Donald Trump is elected, and regardless of who's controlling Congress, I'm very confident that we here at Frazier and Mayer Research LLC are going to be able to navigate the markets in a productive and profitable way, and to be able to help you to do so. I mean, we've done so for over 15 years now, and really individually, I've done so longer than that. But as far as providing information to other investors and financial market speculators, well, not another end there. We've been very good at getting in and out of certain asset classes and sectors at the right times, meaning very near market bottoms and very near market tops. And I'm very confident we will be able to continue to do that. So let me discuss very briefly the upcoming election. Well, as I'm sure all of you know, the polls have at least tightened substantially over the past several days, and it's really difficult to know who's going to win this election. I mean, I don't know. I really don't know. And however, regardless of who is elected, I think we're going to get some volatility in at least the U.S. stock market for a few weeks. And if Hillary Clinton's elected, I think we'll see stocks move a bit higher over the few weeks after the election for reasons that I stated in the webinar, but not all of you not all of you, I'm thinking, tuned into that webinar. So very, very briefly, my thinking on that is people or big investors, institutional investors at least, they do not like uncertainty. And they don't know what Donald Trump's going to do, but they feel pretty comfortable with Clinton's going to likely do, or probably a better way to put it would be what she's not going to do. because I'm convinced she's not really going to do much. She's not going to make many changes, and some of you might be very happy with that. So let's not get into a political leaning here, whether or not I think that's proper or productive or not. I think it's just true that I don't think she's going to make a lot of changes. Whether it's good or not is another issue. And therefore, I think we'll see institutional investors stay primarily in stocks and possibly add to their stock holdings, at least on a short-term basis. And I think stocks will move a bit higher over a few weeks ensuing the election if Clinton is elected. Quite the contrary, my thinking is if Donald Trump is elected, that we're probably going to see a big sell-off initially in the U.S. stock market, and that's because primarily, once again, of the uncertainty that's associated with the Trump presidency. However, longer term, my thinking is that over the next few months, stock prices in general are going to continue to trend lower. And the reason being is really quite simple, is we're seeing a lot of signs that the U.S. economy is going to continue to grow at a slow pace at best over the next several months. And secondly, publicly traded companies that have reported their revenues and earnings thus far, it looks as if, based upon those earnings releases, that we probably are going to find out within a few weeks that in the aggregate, corporate profits of publicly traded companies declined on a year-over-year basis for the 6th consecutive quarter during the 3 months into September 30th. And my gosh, I mean, I'm sure all of you know that the level and direction of stock prices is determined ultimately by the level and direction of corporate profits, the underlying companies of those stocks. So the near-term outlook for the economy and stocks is simply somewhat negative. So I think we're going to see stocks trend lower, at least U.S. stocks, for the next few months, regardless of who's elected. However, looking a bit further out, my opinion is, and my research indicates very, very strongly, that if Ms. Clinton's elected, stocks will continue to trend lower throughout most of the coming year. And the reason being is that, this is not a political comment. This is an economic comment. So those of you that are supporting Ms. Clinton, please don't interpret what I'm about to say as a knock against Clinton, because it's not. It's just based on the comment that I'm about to make is based on how the economy generally responds to certain economic policies. And the fact of the matter is Ms. Clinton has proposed raising taxes on certain high-income persons, also raising taxes, even though she doesn't speak about it often, but she has said that she expects to propose at least that the payroll tax be raised on everyone, and therefore taxes will also be raised if her proposals were to be enacted on middle-income persons. Well, that's definitely not a good thing. Quite the contrary, it's a bad thing. I mean, if people have less money to spend because of increases in taxes that they're paying, well, do you really think that companies that sell products and services are going to sell more of their products and services if people are spending less money? I don't think so. So that's the primary reason that I see stocks continue to move lower throughout much of 2017 if Clinton's elected. It's because of her tax proposals and or lack thereof. Quite the contrary, if Trump is elected, Trump has proposed for big cuts in tax rates for individuals and businesses. And, well, if that occurs, well, that means people are going to have more money to spend. And therefore, companies are going to sell more products and services. The revenues are going to go up. And if they maintain their cost at a fairly constant proportion relative to the revenues, their profits are going to go up. So it's as simple as that. And I'm not going to get into comments regarding trade or immigration. That's not what this service is about. This service is about helping you, our subscribers, avoid the big downturns and to profit from the major upturns in the financial markets. So, my focus will always be on economic factors and developments, as well as the actual trading action in stock markets around the globe. Let me look at my notes here real quickly. I think those are all of my opening comments. So now, in just a moment, I want to move on to our internet website and to go over some more information that's provided our site on a regular basis that I encourage you very strongly to go to at least once a week and to review this information. You can do so in 20 minutes or less, and it'll keep you very informed about what's going on in economies around the world and how stocks and bonds and real estate and commodity and precious metals are likely to respond to those economic factors and developments. So let me pause here just for a moment. We'll go on, and then we'll go on to our website. Okay, well now I'm at the home page of our internet website, which is www.investorsmonitor.com. And those of you that have watched our first two internet TV shows, that is video recordings, since we relaunched our individual investor service, Frazier Strategic Allocator, on Wednesday, October 26th. Hopefully, you've already watched a couple of our videos that where I showed you, our subscribers, where to go on our internet website to keep up with important factors and developments that are likely to affect the direction of the financial markets and the values of your financial market portfolios. So let's do a really, really quick review. Well, the first video, I'm going to take my mouse and put it down over this timing monitor. I went over our buy-sell index, our relative strength index, our sector performance, two charts that we provide regarding sector performance and our overbought, oversold indicator. And looking real quickly at our buy-sell index, well, that index, which is based on our tactical asset and sector allocation model, registered a sell signal in May of last year. Stocks moved a bit higher after that. This black line is the S&P 500. The red bars are the readings on our buy-sell index. When it gets up to this 40% level, it registers a sell. That means to get out, primarily out of stocks. And when those bars get down to a negative 40%, a buy signal is registered on our buy-sell index, which means to get fully invested in stocks. And we got a sell rating in May of last year, and stocks moved a little bit higher, at least the S&P 500 index did. That's the black line again. After that sell recording was registered, then they pulled back sharply on two occasions, but now they moved a bit higher. But that's okay. We don't expect to be able to get in and out of the stock market or any other asset class at the exact lows and highs. I'm saying to get out at the exact highs and to get in at exact lows. And nor is that our goal. I mean, that would be a pretty much unattainable goal. Our goal is to get out of the market near the highs, such as here, and such as here, and to get in near the bottoms, such as here. This is, by the way, late 2002, early 2003. This was, let's see, I think March of 2008. So that's our goal, to get out near the highs and to get in near the lows. And we've been very good at doing that over the past at least 15 years. So I encourage you to take a look at this chart every week, although we only update this chart once a month because we're waiting for all of our indicators to become available. Still, we do update our comments every Sunday regarding our buy-sell index. Next, let's go to our relative strength index. And this we've talked about before. we give a description right down here of what this index is. But as you can see, and some of you are already familiar with this, this is an index that's based on 46 leading growth stocks, leading growth or cyclical stocks, the market leaders. And as you can see, it's been trending lower for 6 weeks now is what this is. That's been, I take that back, it's been a little longer than 6 weeks. It broke through a major price support level 6 weeks ago. It's been trending lower for almost a little over 2 months. And that's a very negative sign, saying to get out of stocks. Then we take our look at our sector performance charts. The weighted average of on a 6 weeks basis of the 10 major economic sectors, that is the price performance of stocks of companies that operate in those sectors, and as well as our sector performance index. And our sector performance index moved lower over the past 2 weeks, and not to our surprise, once again, the blue line is going to always be our indicator, a chart of our indicator. The black line is going to always be the S&P 500 index. And sure enough, not surprisingly, stocks have moved in general in the direction of our sector performance index. As I said a moment ago, we update our comments on these charts every week. And lastly, our overbought, oversold indicator. And as you can see, once this chart loads, that indicator fell last week to the lowest level possible, suggesting that stocks will rebound at least for a few days within the next couple of weeks. I mean, stocks are very oversold on a very short-term basis. Okay, enough about that. Let's get back to our home page. Even though we don't really need to go there, we can these links always stay in place. But this week, I want to take a look at now something new. It's nothing new, let me rephrase, that I haven't not yet covered, and that's charts of so-called technical indicators. And you can go directly to them here, but I think it's easier to click here if you were to visit our site. And the so-called technical indicators, that is statistics that show what's going on in the U.S. stock market, and it's the trading action. Stocks are the trading action in general. I mean, you can go through this on your own, but I mean, let's just go to a very common one that a lot of you are familiar with, the New York Stock Exchange Advanced Decline Line, and peaked a couple of weeks ago. And usually, the S&P 500 index and stock prices in general tend to move in the same direction as the NYSE Advanced Decline Line. And yet, more positively, the reason that I encourage you to always monitor what's going on with the Advanced Decline Line, if you don't already do so, is because it tends to serve as a leading stock market indicator. You can see where it peaked here and in late 1997, and stock prices in general did not peak for about a year later, but at least it gave you a sign that we were probably in the process of nearing a peak. I mean, there's a very big lead time here. If you got out here, you probably got out way too early. But here, it got you back in at about the right time. Maybe just a little bit late, but near the bottom. Here, it got you out near the top and before the peak in 2007. Here, it got you back in at the right time. So a lot of you are familiar with that, and I don't want to spend a lot of time on that. Let's just hit the back button, go back to that big list of technical indicators. And on a positive note, this institutional investors, State Street Investor Confidence Index, which is based on the actual allocations of institutional investors. It's not a sentiment index. It shows that institutional investors actually added to their growth and cyclical stock allocations during September, and that's why this blue line moved up. That's a positive. But the trend overall was down for the past few months, and I expect this to move lower again over the next couple months, if at least if Trump is elected. If Clinton's elected, it's probably institutional investors for at least a short period of time will probably continue to add to their growth and cyclical stock allocations. Let's click the back button again. Just give this a moment. I mean, you can go through all these charts on your own. I don't want to get into a lot of details here, but I encourage you to monitor these stocks, these charts on a regular basis. Our general market timing indicator charts, as well as our technical indicator charts. Also, once a week, I encourage you, and usually we do not update the chart I'm about to mention until Saturday or Sunday of every week. So there's no point in checking during the middle of the week. But that's our chart of the week. And that's going to be a chart of a fundamental economic indicator. Once again, you can go through these on your own. But in this past week, the chart of the week that we put up was on personal income. And when we say chart of the week, we only put up a chart. Our chart of the weeks are on economic indicators, and we only put up ones that are very, very significant. And you'll look, last week's chart of the week was on real disposable personal income. That is the after-tax and inflation-adjusted incomes of Americans in the aggregate. You can see this has been trending lower, oh my gosh, for about 2 years now. That is the rate of increase in after-tax incomes. Well, once again, what do you think is going to happen if tax rates go up and people have even less money to spend? Well, what's probably going to happen is what we tell you down here in our analysis every week when we put up a chart of the week of what's of the impact that economic indicator and economic fact is going to have on the economy and on stocks. It's not going to be a good thing. I mean, the fact of the matter is when people, when their at least rate of increase and their income goes down, well, they're likely to tighten their spending. And because the U.S. economy, the total output of goods and services in the U.S., as is the United States gross domestic product, is accounted for, let me say it in a different way. Because personal spending accounts for approximately 68 to 70% of the total output of U.S. Goods and services, that is a gross domestic product, well, if people tighten their pocketbooks, or tighten their spending, well, we're probably going to see GDP decline, or the rate of increase decline. We're going to see slow economic growth as best, and that's definitely not a positive factor. Okay, lastly, I'm going to hit the home button again just so we can get out of these charts. Instead of really going to any of these charts and spending any of your time on this, you can spend less time just by clicking on our investment environment. Really quickly, here we'll give a description of what's going on from our perspective regarding the investment environment on an overall general basis, from a fundamental basis, and from a short-term trading basis. And also, if you go back up here, put your mouse here again, and you can just click on our rating. You could click this. We'd update this every day, and you don't have to read anything or look at any charts on our website. You can just go here every week and say, well, it's a 3.5. It's less than 5. That's telling me I should be out of stocks. If it's less than 5, you should definitely be out of stocks. And I'm not saying you should not continue to hold some fixed income securities so that you can get regular dividends. And a lot of you rely on dividends to pay your living expenses. But I mean that you should at least have a low allocation to stocks if this reading is less than 5. I feel like there was something else I wanted to mention, so let me click back to our home page. I think that's probably it. So I think I'm going to wrap it up there. I encourage you to go to our website. Now, what I'm going over has nothing to do with us trying to sell you something. I'm trying to get you to go to our website so that you can keep up with what's likely to impact the value of your financial market portfolios. And of course, you don't need to do that. I mean, you've subscribed to our Frazier Strategic Allocator, and we provide these videos every week. This internet TV show. Once a month, we give you a monthly report that covers a lot of factors and developments that are likely to affect your portfolio. And and every week we provide you with a written weekly commentary. So you don't really need to go here, but it's something else that's available to you if you choose to do so. So I thank you for watching and listening, and I'll speak to you again next week.